Are you worried your hard-earned investment returns will be eaten away by inflation? These investments and inflation hedges could help. Hey guys, I'm Jasper, a financial market analyst working with Trading 212 to help improve your financial education. Please note that nothing in this video should be construed as financial advice. In the next 10 minutes, I intend to answer the following questions. What is inflation? What is an inflation hedge? And what stocks normally do well with high inflation? At the time of filming this video, inflation happens to be at a 40-year high in the UK, Europe, and the United States. There are 5 ingredients that I take into consideration when choosing the stocks I should own when inflation is high. But before I get to that, we first need to answer the question, what is inflation? Inflation is an increase in the price of goods and services over time. Basically, the things you buy cost more than they did in the past. So really, it's nothing complicated, and I'm sure most of you knew this. It's usually measured as an annual percentage change. Central banks like the US Federal Reserve or the Bank of England tend to target 2% annual inflation. This is what they refer to as price stability. So by that standard, 2% might be considered normal, while above or below 2% is abnormal. Inflation can be caused by a variety of factors such as strong economic growth, accommodative monetary policy, and the low supply of commodities and raw materials. When inflation is high, it can be difficult for consumers to keep up with rising prices because wage growth often doesn't offset the higher cost of living, and this can lead to a lower living standards. But aside from its effect on consumption and the economy, inflation can also eat into your investment returns and lower your wealth. Since investing is all about raising our wealth over the long term, inflation absolutely requires our attention. Before I move on to the types of investments that can be made during inflation, let's just explore how inflation affects our current investments a little further. Personally, I need to know why something matters before I do anything about it, and since you're watching this video on this topic, you're probably the same. When inflation is high, investment returns tend to be lower because the purchasing power of money invested decreases. For example, if you invest $100 in a stock when the inflation rate is 10% and then the stock price stays the same, the value of your investment will be worth $90 in purchasing power after 1 year. To be clear, you will still have $100 worth of stock, but instead of that $100 being able to buy you, say, 10 McDonald's Big Mac meals, you'll only be able to buy 9. This is why they call inflation a hidden tax. In this example, the stock you own has not gone down in price, but you just lost 10% of your wealth by owning it. In order to combat the effects of inflation, investors can invest in assets that are expected to increase in value at a higher rate than the rate of inflation. I split the way I think about investing with inflation into 2 camps. 1, hedging against lower stock returns, and 2, stocks that do well during periods of high inflation. Okay, so what is an inflation hedge? An inflation hedge is an investment that's designed to protect against the effects of inflation. As I've just talked about, inflation can erode the value of investments, so a hedge can help offset this. The mainstay of a portfolio tends to be stocks and shares. So if inflation is causing the stock market to drop, then other types of investments can be used to limit losses on stocks. There are different types of inflation hedges, including gold, commodities, real estate, and treasury inflation protected securities known as TIPS. I'll delve more deeply into these asset classes in future videos, but one point I'd make very quickly now is that it's a lot easier to invest in these things than it once was because they're all available through ETFs. If I pull up the Trading 212 app, if you go to search and tap ETFs, you can see REITs, commodity funds and fixed income funds, and alternatively you could just type in whatever you're interested in like tips in the search field to find matching ETFs. Okay, let's get to the meat of the matter. Stocks that do well with high inflation. Stocks don't really fit under the category of an inflation hedge. The reason is there's not a uniform impact that inflation has across the entire stock market. That's due to the huge variation in businesses issuing shares. Historically, the stock market has both risen and fallen during periods of inflation. In my previous video on what is a bear market, I talked about the basic idea that it tends to be easier to pick a stock that will go up in price during a bull market than a bear market. Dealing with inflation is a different kettle of fish than dealing with a down market. Again, the stocks you own can rise in price when there is inflation, but if they rise less than the rate of inflation, you're still losing purchasing power. When thinking about inflation-proofing a portfolio of stocks, I think about these 5 ingredients: sales, pricing power, commodities, interest rates, and the economy. The first is revenues. If goods and services cost more, then consumers and businesses will need to cut back cut purchases in some areas. So investing in companies that will not be on the receiving end of those cutbacks is one approach to investing during inflation. Companies most likely to be able to keep selling during inflation are those that sell essential goods. Fortunately, there's a whole sector of such stocks called consumer staples. On the Trading 212 app, tap the search icon. Under the Stocks tab, select Browse All. Choose the country you want to invest in and then select consumer staples. You can see here some of the household names that you probably buy from every week, including the likes of Tesco and Unilever in the UK or Procter & Gamble and Walmart in the US. The other types of companies that can withstand the effects of inflation are those with pricing power. Pricing power means that the company can raise prices with minimal effect on sales. When there's inflation, companies will have to spend more on supplies. But if they can raise prices, they can pass on the higher costs to their customers and maintain their profit margins. This might at first glance be a harder statistic to seek out, but a good proxy for pricing power is gross margins. That's because you need pricing power to have a handsome profit margin. Otherwise, competition will step in and take your business by accepting slightly lower returns. We can choose any sector when on the hunt for pricing power. But if we stick with consumer staples, let's choose from the top of the list at random, which is BAT. In the app, after you've tapped BAT, you can scroll down to the key ratios and then tap More Ratios. Now scroll along the top tabs to Margins. The closer the margins are to 100%, the better. Here you can see that the 5-year gross margins are high at 81%. Then if you scroll down to Net Profit Margin and Operating Margin, it all looks secure too. Again, I've selected BAT at random, and there might be other mitigating factors not to invest in BAT, but from a pricing perspective, it ticks the box. Moving swiftly on, the source of high inflation often starts with the price of raw materials. This is known as cost push inflation. When demand for a commodity surpasses supply, the price of the commodity should go up. A higher price for commodities will tend to lead to higher profits for companies that produce and sell them. Commodity producers include miners, the biggest of which tend to be Australian like BHP and Rio Tinto, while others are often headquarters in the UK with operations overseas like Anglo American, Glencore and Antofagasta. Oil companies are another kind of commodity producer. Most of us know big oil companies like BP, Shell, Exxon and Chevron, but there are many others, and at the time of filming, Warren Buffett has been increasing his stake in Occidental Petroleum. The other side of the equation is that rising raw material prices can lead to higher costs for companies, which can eat into their profits. Finding companies that don't depend on raw materials can also inflation-proof your portfolio. The job of central banks is to keep prices steady. When there's inflation, central bankers normally jump into action to reverse it by raising interest rates. The stocks that should benefit most from higher interest rates are banks. The core measure of a bank's profitability is its net interest margin. That's the difference between the interest income generated from borrowers and the amount of interest paid out to lenders. When interest rates rise, the difference between what banks earn and spend in interest tends to rise, earning them higher profits. But there is a big caveat to all this. If the inflation is driven by high demand, i.e. a strong economy, then banks should benefit, as I've just outlined. However, if the inflation is happening in a weak economy, for example, because of supply constraints, then it's likely that inflation will cause loan defaults, which could offset any benefit banks get from higher interest rates. Continuing along the same lines, it really matters in what context inflation is happening. A strong economy tends to see strong demand outpace the supply of goods and services, which leads to inflation. This is healthy and good and a sign of economic expansion. In that environment, it makes sense to own cyclical stocks that perform in line with the economic cycle. That can include airlines, hotels, retailers, and banks. On the flip side, if inflation causes an economic downturn, then it makes sense to own non-cyclical stocks. Consumer staples that we already mentioned are non-cyclical, as are utilities and pharmaceutical sectors. Keep in mind that inflation isn't the only thing affecting our portfolio. We want to take account of inflation while taking a holistic approach to portfolio construction that accounts for all the different variables and always focus on our long-term investing goals. So let's review all that. I answered these 3 questions. What is inflation? What is an inflation hedge? And what stocks usually do well with high inflation? After all this talk of inflation, I feel deflated. So over to you. Please share with the 880,000 and growing YouTube subscribers what you think about inflation and how has it changed your investing, and what stocks are you buying and selling. Leave a comment below. And if you like this video, please make sure to smash the like button, subscribe and hit the bell icon so that you see more videos like these as soon as they're released. Thank you very much for watching and happy investing.